All right, good afternoon, everyone. Everyone's feeling good? Ready to break out those calculators? Don't worry, there's none of that in this class. A little bit, yeah, but more conceptual rather than asking you guys to do complex Excel calculations. So let's dive, oh goodness. Something wrong with my presentation. Oh, here we go, it's back again. All right. So just to give you an overview of what we're going to be talking about for the next 90 minutes is, first we're going to do a quick introduction on what is unit economics. Some of you may not have heard that term before, so let's get you quick up and running in terms of what the definition is and how different ways and perspectives to understand what it is. And then we're going to go into a deep dive. First, SaaS, which you've probably seen the acronym floating around for the last couple of days, which means software as a service, and understanding what unit economics is in those kind of companies. And then we're going to take a short break after that, and then we're going to jump back into products and services and understanding what does that look like for a unit. And then finally, we're going to connect it all back into decision making. What does all of this like mumbo jumbo mean if I'm managing a company and I'm trying to think about what are the decisions that are in front of me and what are the choices? So let's jump straight in. So how many of you are very familiar with financial statements or finances in general, just to get a sense of what the room is like? Can you just quickly put up your hands? You've seen a financial statement, balance sheet, cash flow. Okay. Cool. So, for those of you who have not seen that, a typical way that a company would think about how is my company performing in general, like what are my revenues and what are my profits, the typical way that someone would think about it is a top-down approach, which is your financial statements will tell you, all right, so annually, I'm making X amount of dollars. Or annually, this is my fixed cost. Or this is my variable cost. This is how much I'm making in sales. And that's a very typical lens of how someone in investment banking, how some of the key metrics that you will be reporting to venture capital, to VCs, would look like and would ask for. From the perspective of an entrepreneur, or even actually as a VC, some might ask for it, is the bottom-up approach of actually understanding how is my company doing from a single unit that I am producing. So what that means is that if your company produces iPhones, for example, what is that unit of a single iPhone and how much does it actually cost for that individual product? Typically, when you look from a top-down approach, you're looking at a blanket sort of 1 year, I made 10 million ringgit. Great, but what does that actually tell me? So we're going to go dive in deeper into what does that single unit means. Which brings me to the question of what is your unit? And I have a picture of a plane here, which I think is really interesting, but that just goes to show that a unit changes according to the type of company that you're in. So the definition of a unit is your most significant marginal investment of your company. I'm going to repeat that again, because I know there are a lot of complex words. So a unit is your most significant marginal investment for your company. So what that actually means in English, in normal day-to-day English, is what is your most important investment that you're actually putting money behind? So if you're producing iPhones, your iPhone is your most significant unit of investment. If you are a service company or a retail company, your most significant investment is your retail store, if you have a chain of them. If you are a software company, a SaaS company, your most significant investment is your customer. So it varies according to the spectrum of companies that you're in. Does everyone get that? Yes? I'm seeing heads nod. All right, we're good. You're still with me. This is great. This is going well. All right, so now we're going to talk about, when we look at the entire landscape of companies, there are so many different types. But what it can kind of be boiled down into is a spectrum from product-based companies to service-based companies. And what I mean by product is physical products on end of the very end of the spectrum, to service companies, to, for example, a law firm is a pure service company. They don't produce any physical products at all. What they give in terms of value is their time and their expertise. And somewhere in the middle of that is software as a service company, so SaaS companies, because their product is their software and it's providing a service. So what I'm going to do for the next 90 minutes, actually, is going to walk you through what does unit economics look like for the very middle of the spectrum, which is SaaS, which we're going to dive right into. And then we're going to go look at both of bookends of the equation. And let's take a look at what that looks like. So first, SaaS companies. When I think about unit economics for SaaS companies and what you should be measuring, I like the analogy of leaky buckets. It's very easy to remember. It's very memorable as well. It's basically, when you take a bucket and it has holes in it, there are 3 activities that happens. 1, you add water. 2, there's water in the bucket because you just added it. And 3, water leaks out because there are holes in it. So those are 3 ways to think about finance and unit economics in SaaS companies. That's all you really, if you take away nothing, I'm going to tell you this right now because I still have you in the first 5 minutes, think about leaky buckets. And you're like, right, I remember. And the comparison to that is, 1, when you're adding water, that translates into how many customers are you acquiring? So think of the bucket as your business. How many customers are you acquiring? The second is how much water is in there. So how many customers are actually still staying with you and they're still happy? And the third is how many customers are unhappy with you and they're leaving. It's a very simple and very sort of 3-dimensional, 3 sort of levers to think about it. So the first one, let's talk about how you're acquiring your customers. I like to think about unit economics in 4 dimensions. And we're going to repeat these 4 dimensions over in retention as well as with churn. So, first one. And one of the reasons why I like the leaky bucket analogy is because it's very comparative to physics, where the rate at you adding water, the amount of water that you're pouring in, the time, how fast are you pouring it in, and the type. So what kind of water? Is it water? Is it juice? Like, what are you pouring to your bucket? So this should be very memorable for you guys. And so let's dive in a little bit deeper into sort of the very first one, which is rate. So basic question. The key question that you should be asking yourself is, what is the rate of which you are acquiring your customers? Are you looking at acquiring them monthly? Are they annual customers? Are they quarterly customers? How are you reaching these individuals and how are you actually getting water into the bucket? One of the examples that I really like is, and then you design your service around them. So I have an example up there, which is basically 2 of my favorite SaaS products. One is quarterly.co, and the second is Dropbox, which I'm sure all of you are familiar with. Quarterly.co is a monthly sort of package service where you subscribe, and then for a set amount every single quarter. And every quarter, they send you a pre-package of some goods that you have signed up for. So if you're interested in lifestyle, they'll send you some sort of like interesting like lifestyle pieces. If you're interested in sports, they'll send you cool new gear. And for them, they're acquiring customers at the rate of a quarterly rate. If you think about Dropbox, they have multiple plans for you to join. So it could be monthly, so you can sign up for a monthly Dropbox, or it could be annual, which I'm sure like $99 per year, which is really a great deal for Dropbox. And those are just examples of different companies thinking about the different rates of acquisition. The second one I want to talk about is amount. So how much water are you actually pouring into the bucket? And I segmented out into understanding, is this new water that you're pouring in? Like, where's your source of your water from? Is it like completely like new market, has never heard of your product before, or are they returning? Perhaps there are people who have signed up for your product 2 years ago have left and they're coming back. Are they free? So there are a lot of like free services out there. So how are you thinking about that? Or are they paying? And what is the size of these customers? So is it that they're coming to you and they're an enterprise type customer, where the contract size is $1,000 for a month? Or are they retail customers? They're only signing up with you for $5 a month. All of that makes a difference. The other two dimensions to talk about is time and type. In terms of timing, the biggest thing that you should be thinking about is, how does your sales cycle match your offering cycle? I'm going to say that again because I think that's very important. How does your sales cycle match up with your offering cycle? And one of the reasons why this is important is because if you have a sales team, so let's say you have some sort of product where you're selling analytics for social media, and you have a sales team, and you believe that your sales cycle to close a customer is a month, but you are offering your customers annual contracts. How are you thinking about the cycle of how quickly you're acquiring those customers is really important. And the second one is your type. How are you thinking about acquiring your customer versus maintaining your customer? Those two things are very different. And finally, how are you thinking about acquiring your customer if they're already in your customer base? If you're upselling them, if you're cross-selling them. If it's a cross-sell, do you consider them a new customer if they buy a new product? So if you have multiple product offerings, for example, Amazon. If you're an Amazon user, an Amazon Prime subscriber, but you also then cross-sell into Amazon Web Services, which is very different than their retail line. If you're an Amazon manager, would you think about the user who already has Amazon Prime and now has signed up for Amazon Web Services as a new customer? Or are you thinking about them as an old customer? The way that you calculate those metrics are very different. And there's not necessarily any right or wrong, but just making sure that you are aware and intentional about the way that you're counting what matters. So, on the acquisition side, the main metric, there are multiple ways to think about it. And you probably have seen this from some of the other speakers. I know Randy was speaking about it a little bit earlier, is what is your customer acquisition cost? So basically what that means is, how much does it cost for you to get a customer that will pay you money? So let's do a very quick exercise. This is the extent of the math that's going to be in the session. So don't worry. It's very easy. Let's take a look at the variables. One, you have a marketing campaign for $2,000. And in this marketing campaign, you're like, all right, I'm going to sell this brand new product, which is going to be amazing. And then you get 100 unique views of this campaign, of your new product that you're launching. You're like, okay, great, that's not too bad of a conversion rate. And then 25% of those individuals who saw the campaign ended up purchasing your product, which is really great, right? 25%, that's a high conversion rate. I guess my question is, what is your cost per customer? Very, very simple. Anyone? 80? No. Cost per customer. We're not talking about like actual conversion. Cost, just pure cost per customer. Per view. Let's make it easier. Cost per view. Yes, excellent. How many conversions did you get? Yes. Yeah, 25 customers. And what is your customer acquisition cost? Yes. Excellent. There you go. Super simple, right? Everyone can do this math. This is great. And this is just to show you, and the reason why I intentionally broke it out into those 3 lines is it is important to know what is your cost per customer that did not purchase your product, and understand what is your conversion rate. And make sure that you distinguish between the two. All right. That was acquisitions. Does anybody have any questions so far before I move on? Yeah.
So you're differentiating between someone who took a look at your product versus someone who actually bought
Yes, absolutely.
So in my mind, we're calling both of them customers.
Well, then that's completely up to you to like name it. So it could be like customer views versus actual like customers. Yeah. Yep. Sorry? How I calculate it? Okay, does anybody want to share how they got to 80? This is where people put up their hands and they're like, oh, I know how I got to 80. Anyone wants to share? Yeah. Yes.
Actually, your 100 views, you only get 25 people to buy your product. So it's only 25 people who can you get from this 2,000 investment marketing dollar, I mean. So 2,000 divided by 25 is 80.
Yes. Thank you. What's your name? Oh, great. Good job. Thank you so much. Did that answer your question? Excellent. I love it. I love peer-to-peer learning. Yes? Excellent. Great. All right. Let's move on. Okay, now we're in the bucket, guys. We're in the water. We're swimming. And now let's talk about customer retention. All right, same thing here. Whoops, my text is a little bit off, but same thing. Haha, surprise, surprise. The same 4 dimensions apply. It's just that now you ask different questions. You're still asking how long, and you're still asking and how the amount. You're still looking at the time and the type, but the type of questions are there a little bit different. So let's dive a little bit deeper into them, shall we? 1, the rate. There are 3 ways to think about the rate that we're retaining a customer. 1 is your renewal options. How are our customers renewing? And how are you offering that service to let them renew? Is it a natural sort of opt-in where they don't even need to, where they actually have to give their permission and you send them an email and you're saying, all right, your quarterly subscription is up. Please renew with us. Or is it an automatic, all right, we're going to credit your credit card anyways, whether you like it or not. And if you don't like it, then you should tell us. But that's one way to think about customer retention. The second is actual cancellation options. So if a customer chooses to leave you, how are you keeping in contact with them? So for example, if I have canceled my subscription to Amazon Prime, will I still get Amazon newsletters? I know they don't send those, but using this previous as an example. How is Amazon still keeping in contact with me? Are they sending me sort of monthly emails to let them know what new sort of prices are coming up? Or are they sending me new product features? Like, it's important to think about like how you're giving the customer the option to stay or not stay. And finally, and this all leads to the ease of the customer experience in both of those processes. And one of the reasons why this rate of retention is really important, and it's very different to churn, which we'll talk about in a little bit, is because customers in this bucket have already chosen to be with you. Now it's your job not to screw up. That's the basic mindset. Sort of like when you're on a date with someone and you're sitting there on dinner. They're already on a date with you. It's just your job not to screw up. All right, and now let's talk about the amount. So this, I like to think about it in 2 perspectives, which is the expansion versus shrinkage. But what this also means is, if a customer is with you, are they choosing to stay with you again and adding on to their original sign-up? Or sort of like an add-on package? Or are they choosing to like, not so much. I'm actually going to shrink my sort of contract with you and actually like step down this because I'm not so into it. And it's important to like measure this because this will tell you a lot about your service offering. Again, going back to the date analogy, if that person agrees to go out with you on the second date, you're like, I did something right. If the person's like, not so much, let's have a phone call, you're like, all right, I definitely did something wrong. And the other 2 components is time and type again. We're going to be repeating this for churn as well. So you see the same 4 dimensions. At the end of this leaky bucket analysis, what you should have in front of you is a 3x4 matrix of time, type, rate, amount, acquisition, retention, churn, and be able to fill in all of those boxes, if that picture makes sense to you. Anyways, so time. How are you renewing your contracts? And what is the overall value of the customer? So, and finally, type. How are you counting the number of customers versus the engagement of the actual product and service? I'm going to let you soak it in a little bit. Though both of those things are very, very different. The 2 metrics to measure in terms of retention in this middle component of the bucket is 1, your lifetime value of the customer, which is basically how long does someone stay with you? And secondly, what is your average revenue per user? So basically, how much money is someone giving you? I'm going to walk you through this. I'm not going to make you guys do any math because it's a little bit more complicated to come up with an example for this. But basically, the lifetime value of your customer is your expected life of your customer, which is basically how long. So if you have a quarterly subscription with your customer, that's 4 months. Multiplied by your average revenue per user, which is how much money does someone give you, multiplied by the gross margin of that customer. So if it's a product, if you have a gross margin on that product of $50, that will be in there for that single unit. And I have a small equation of what gross margin is, which is revenue minus cost of goods sold divided by revenue, which is pretty straightforward. And then finally, your average revenue per user is pretty straightforward. It's your total revenue divided by number of users. And one thing I would like to say about the ARPU is, given that we're trying to segment out the different types of customers. So if you remember back to my customer acquisition, and when I was talking about the type of customer, make sure that you segment out your revenue that you're getting from if it's a retail customer, or if it's an enterprise customer, or if they're annual contracts versus quarterly contracts. That should be carefully segmented out when you're calculating your ARPU. All right. Does anybody have questions about this before I move on to the third part?
Can we just go back just the slide?
Sure. Any questions? Yeah. Why don't you go?
You said that you have to segment the customers just before you calculate the
Yes.
value.
Yes.
Okay. So you would have 2 different values. Yeah. So the different values for how much
You would have different, yeah. So the thing about unit economics is that the more granular that you understand what type of customers they are, the more that you can then isolate the variables in terms of understanding what can you fix and what can you learn from and what's better, right? So if you're doing something really, really well for enterprise customers, or let's say that not even enterprise, let's say you're segmenting your customers by country. So let's say you're doing really, really well in Malaysian-based customers versus Singaporean-based customers. You want to understand as a business, oh, wait, this country is doing really well. What am I doing here that's working? Is it my sales team? Is it the way that I'm positioning the product? And what can I bring and what lessons can I learn from that to bring it into the Singaporean market? Yes. Mm-hmm. Sorry, when you say premium? Freemium.
How do you account for the non-paying customers?
You still account for it. I'm going to skip ahead very quickly to this. So you still account for it. You just segment it out into a different sort of branch. Like, I'm assuming that someone's paying for your business at some point, that you're not just operating on a free business. But it's important to think about, like, dividing out. You're basically building a customer tree for yourself. And if your free customer tree is like 10,000 visitors on the free side and on your paid side is 5,000, that's great. But that's for you to know actually, oh, wait, my ratio, this is the exact ratio of paid to free that I'm trying to get to.
So going back to the formula.
Yeah.
Right. In a freemium model, let's assume you have only 2 tiers, free and $10 a month.
Yep.
For instance, with 50% on both, 50% paying, 50% not
Mm-hmm.
paying. So how do you account for the non-paying one? Like say cost of goods sold. That, the ratio of paying and not paying will affect your cost of goods sold.
It's different when you're talking about it in a product company versus like a physical product versus a software company. So your cost of goods sold, it's your overhead fixed cost. Right. So it's treated very differently. In a physical business, it would affect it for sure. In a software business, that's pretty separate. It's a sunk cost upfront.
So you're just looking at marginal costs.
Yeah.
Okay.
Yep.
Say for a company like Amazon,
Yes.
how would you calculate the expected life of the customer? Because they might buy one thing, and a year later they come back, and another year later they come back.
Fantastic question. What's your name?
JJ,
JJ? All right. You skipped ahead all the way to the end of my presentation, so I'm going to remember your question, and I'm going to explain it because I have a slide for it. But that's a really good question, so let's keep that in mind. All good? All good? Great. All right. So let's talk about like the final part of the bucket, which is churn. Churn is basically what is leaking out of the bucket. Again, let's talk about it in the 4 dimensions. This is very straightforward. Rate, amount, time, and type. Let's talk about rate first. So the rate is basically what percentage is leaking from the bucket, which is pretty straightforward. The amount is, can you actually afford what is leaking? So obviously, if you have more holes and if your churn rate is higher and you have a very short runway, you would not be able to afford it. So basically, it's understand how much is leaking. And then time. And I put time in there because it's important to think about, like, maybe there's specific times of the year. Or maybe there's specific times, like in the summer or during Hari Raya, that people sign up more. Or they lose and they leave because they're not interested in renewing their subscription. Or maybe it's after you haven't pushed out a marketing campaign and your marketing campaign only comes out every 6 months and people forget about it. Like, it's important to understand, maybe there's some sort of pattern of when people are leaving. Maybe it's like right when they receive the, oh, please subscribe, and they don't. Maybe there's something in the messaging there. So really understanding what the drivers are. And then finally, customers versus dollars. If there's anything in terms of churn that you need to know is this. How many customers are leaving versus how much money are you losing? So what I mean by this is you can have 100 customers leave, but in terms of dollar amount, if they're only giving you $1 each, you're only losing $100 a month. But if you have a large enterprise customer that leaves, and their contract size is $10,000, that's huge, but that's only one customer. So I guess for you as entrepreneurs of a business, what do you care about more? Do you care about the number of customers that you have, or do you care about the amount of dollars that you're losing? And especially in freemium businesses, I'm guessing that you care more about the number of customers versus dollars, but it's really important to distinguish both of them. All right. And finally, for these three is, okay, we just went through the 4 dimensions. We talked about the leaky bucket. I guess the big question now is, how do they all relate to each other? And I just showed this slide earlier. This slide before that is the customer acquisition cost should be less than your lifetime value of your customer. So if you don't look at the slide for a moment, you just think about it, right? I should make sure that the cost that I'm putting up front to make sure that the customer comes is actually going to be worth it because I want them to be with me for a long time. So if I'm spending a ton of money acquiring a customer and they're only staying 1 month with me, that's not worth it. So this is the basic customer acquisition cost has to be less than lifetime value of the customer, which will result, and hopefully you get to sustainable churn, which I will talk about in a little bit. And then in SaaS companies, the potential standards to hold yourself up to is that your lifetime value should be 3 times your customer acquisition costs. It's just standard in the industry, and that your customer acquisition, the cost to acquire your customer should take less than 12 months to recover. Does it make sense? Excellent. I'm seeing nodding heads, which is a good sign. And the final thing in this, because I know I threw a ton of information at you, is, and I've shown you this tree before in the Q&A a little bit, is basically what you want to do is that when you're starting a business, build out your customer tree. So I built a very simple one out. I built out the left side, not so much on the right, because it couldn't really fit in my slide, and I wanted to show you how many levels down that you can go. So total customer, new versus returning. We talked about that. We talked about paid versus free, and then your different channels, like different types of customer. Are they acquired through online ads, offline ads, direct sale, where you're picking up the phone and calling them? The more that you can understand which customers fit into where, the better then you can calculate your cost to acquire a customer. Each of them will have a leaky bucket next to them as a little icon, if that helps in visualizing what this customer tree is. All right, does it make sense? Yes. Sorry? Mm-hmm. Yes. That is, in SaaS companies, so remember how we talked about the spectrum? The more that you move along the spectrum from product to pure services company, the more that you separate out the cost to maintain and the overhead fixed costs. Because if you think about it, pure services company, pretty low fixed costs. So if you have a law firm, you have a building, you have like stationery, you have tables and chairs, and your cost is basically the unit of the individual versus product where you have ongoing material in order to maintain it. The more you want to separate it out as a different calculation, what we're trying to do here is be very specific on cost to actually keep the customer in. Those are two very separate things, if that helps. Yes. Yes. If when you say your company is new, do you have like any sort of benchmark? Mm-hmm. Initially, it will be a guess, and this is when you iterate towards product market fit. So if you're selling property and your user is with you for over a year, you try it out with 12 months first, right? And if that doesn't work for you, and which is why it goes back to your sales cycle and how long your customer is with you, right? So it really depends on the type. I'm not 100% sure what type of property that you're in. Typically for like software companies, you have a pretty set, you have a hypothesis. All right, I think monthly contracts will work, or I think quarterly contracts will work, and then you start testing that. If you suddenly switch, so let's say, and this how it goes back to how all of this relates together, right? So let's say that you started with a company, you're like, all right, I believe that these are annual contracts that I'm going to have with my users, but I'm finding that the churn rate is really, really high, and that's not sustainable for me. Like a ton of customers are leaving. So that's maybe when you sit back and you're like, next quarter I'm going to try in this small percentage of customers, maybe a quarterly contract or every 6 months, and that's when you sort of like keep tweaking, and which is why it's really important to build your customer tree, because maybe your customers in PJ are doing really, and they're like, all right, yearly, that's it, that's all I really want. But your customers in Bangsar are like, no, I want quarterly. But it's important to like think about them in different ways and tweak it. So I don't have this is it, but it's more so test it and see what fits. Any other questions?
For SaaS,
Yes.
is there a healthy benchmark for ratio for paid and free customers?
No, there's no right or wrong benchmark for paid and free, unfortunately. I think that it varies very, very widely in terms of type of customers. Yeah. Any other questions? Cool. So what we're going to do now is actually take a quick break because I threw a lot of information at you. So just take some time, absorb it. And if you have some time, there's an article that's in front of you that I would love for you to actually just read. We're going to read it again right towards the end and have a discussion. But take a break, have a chat. There's no expectations that you will read this article right now. You will have time towards the end. But if you want to be a keener and you're like, oh, yeah, I should read this, take a read. Let's talk about product of a single unit. Unit economics for a product is very typical of straight up, this is straight up finance where you, as an accountant, you will calculate what is my input and what is my output. And the bars are just meant to sort of signify how much money is coming in and how much money is going out. Same leaky bucket analysis. And minus the actual retention because your product, you're actually creating a physical product. So your input in this is your revenue and unit lifetime, and your output would be your capital expenditures, your cost to acquire the customer, your marginal operating costs, and your maintenance capex. I think someone earlier had asked about like maintenance capex and how does that factor into it. So that's exactly what it is for a product for a single unit. All of that adds up into your contribution margin of your single product. So the better that you understand that, the more that you can actually scale your product. So for example, your maintenance capex for a single product would probably improve over time if you have a single production factory and the more units that you produce, the lower the cost per unit it could get for materials to actually operating machinery. So that's an example. So it changes according to the type of product that you're actually producing. This is a very generic one. As a quick example, I like the idea of products as a store. This is a quick snapshot of the unit economics of Chipotle. So if you're in the US, Chipotle is like this chain burrito store that everyone goes to. Really good food. I love Chipotle. I go to them a lot. They give you huge servings. It's delicious. But the way that Chipotle actually thinks about the unit economics is as a single store because they have so many. And to them, that's the most important. Is that store that they have earning money or is it not earning money? And one of the more incredible things about Chipotle, and the reason why I pulled this up, is on the left side are the numbers of Chipotle. CMG is their trading ticker. And on the right side is the retail average and how they compare to the industry. So you can see on sort of the left-hand side on how they're actually like, let's just focus in on one number, which is their EBITDA, which is their earnings before interest and tax margin over their revenues, I guess, as a percentage, is 27% comparatively to the industry average of 20%. So this is an example of their input and output. So they broken down their operating costs. They have their average sort of capex, how much do they have in inventory, how much does it cost in terms of land of their store. But this is just an example of an analysis for Chipotle. The second thing I want to talk about is services. So a service company is extremely different to a product company. So let's talk about if you are a service company, let's say a law firm or a consulting firm, your most important, again, going back to the question, what is your unit? Your most important investment is the individuals that are in the consulting firm or the individuals that are in your law firm. So think about it. The way that a consulting firm works is that you have a couple of partners, maybe 5 to 10, sitting right at the top, and they're the rainmakers. They're the ones that bring in all the deals. So in a consulting firm, your unit will be on the right side, so which is the partner in the middle, supported by their associates, supported by their minions, whoever it is, like their executive assistant, like the associate, their principal that's supporting them as a team. And you count that as a single unit within your company. So if you're a lawyer, a partner in a law firm, you're on the right-hand side as well. That's you. You have your team with you. You create deals. You win your law cases. That's the way that you calculate efficiency and productivity in your company. And on the left-hand side is if you're a small boutique business and your most important is like a single partner or just maybe a single individual or a single salesperson. It varies. I'm just showing you a comparison. But it could be the right-hand side could be your entire sales team, the way that you're thinking about it. Or regional sales teams could be different as well. But that's for services. And that's what's important to count. Before I move on to decision making, does products like, I know I didn't go into as much detail in terms of calculations of what matters for products and services, but that's only because it's pretty diverse. Do people have questions about it? Excellent. I am, oh, okay.
For services, do you calculate the individuals or time cost or
Yep, you do.
expertise that you
Yep, so you calculate the, well, I guess you think about the expertise. The time piece is basically their salaries. So it's like, the nice thing about services is it's basically how much are they earning and how much does the entire unit cost you as a company and how much deals are they actually bringing in. So like a consulting firm like McKinsey is like, are the partners actually bringing in enough deals relative to the amount of salary that you're paying the entire unit? It's pretty straightforward, if you think about it. Any other questions? Yeah.
So if a company have products and
Yes.
it provides services as well, so we just separate it to different units.
Can you give me an example?
Okay, let's say, okay, my product is for events. It's a software, it's a SaaS.
Mm-hmm.
But because it's event-based, so it's something we have services to sort of
Like put on events and all of that? Yep, you would have two different unit economics. So one thing about unit economics to know is that within a single company, you can have multiple measures of units. You don't only have to have one, because most companies have like many different departments and many different product offerings. So you could be like an events management company where your actual like service is we put on an event and you have an events team that goes out to actually put on an event. But you can also have a software service where you're actually providing them, linking conference people up with each other. That could be, and that has a very different measure of unit versus the actual physical touch person. And you can have two units, and that's great. The main thing is like knowing that you're separating both of those units out. Any other questions? Yep.
Is there any good advice to counter like you mentioned the Thailand would work for some time and then they jump to other countries?
Yeah, I think that's more so thinking about, you're talking about sort of like churn for talent. I think that's a bigger question of culture, job opportunities, growth opportunity within your company, the way that you're positioning, like are they learning enough? Are they actually being challenged? Do they have enough autonomy in terms of the way they are conducting their day-to-day? And also creating a pretty transparent culture that you know that it might happen. Sometimes churn happens because it's an automatic turnover, you know, with certain roles. Like for example, if you're a young banking analyst, there is a natural 2-year turnover that everyone will leave the company. Or if you're in accounting, once you pass your CA, most accountants leave the firms, and that's pretty much expected. But I think it's not one single answer for that. All right, so let's talk about now the interesting thing about unit economics, and this goes back to actually JJ's question earlier, is that how does all of this correlate back to decision making? And how as an entrepreneur and CEO of a company think about how is all of this being managed? And I want to talk about it in 2 dimensions. The first one being growth. And growth is important because as a company, you want to grow, you want to acquire more customers. And I want to talk about growth very specifically in terms of understanding your marketplace. And you've probably seen this framework before, which is basically understanding what is your total available market, your serviceable available market, and your serviceable, obtainable market. So what that means is if you are an events management company and you believe that you can provide amazing conference events to entrepreneurs and link them up to investors, and you're seeing this total available market of the entire country of Malaysia, but realistically, not everyone in Malaysia is actually an entrepreneur or investor who will be interested in it. So that market size shrinks a little bit to, okay, wait, what is my marketplace I can actually serve? And then finally, that small little egg at the bottom is actually, out of that percentage of the market, how many can I actually obtain realistically? So segmenting into 3 of those is really important. But talking about it from the lens of unit economics is that, let's go back to the leaky bucket analysis. So if you're acquiring customers at a certain rate and you're retaining them, but also churning through them, it's really important to think about what is the relative size of the market that you're actually playing in. So let's say you have a SOM, so your serviceable, obtainable market of 100 people. Let's just assume very small numbers so we can talk through this. Let's say you have 100 people in terms of your SOM, your serviceable, obtainable market, and you're acquiring customers at the rate of 1 customer per day. That means that your entire market, you can obtain them in 100 days. But let's say that you're churning through them at 50% per day. So you're losing half of them every single time you acquire one. That market size is going to shrink very, very quickly, and you're going to be out of a marketplace in less than 100 days. So when you're thinking about growth and decision making, understanding how big is your market and how many people are you actually reaching out and how many people are leaving you is really important, because once you know that, all right, I'm going to reach my ceiling of my market in about 2 months. How should I be either repositioning my product, opening up into new market segments, thinking about new ways to market, or maybe get back those old customers? Like, that's something that as a manager you should be proactively thinking about. The other thing that you should be thinking about is how are you managing your runway? And runway in the sense of how much money do you have in the bank? Whether it is your own, whether you have raised venture capital funding, whatever it is, but how much money do you have left in order to actually run your company? So let's say that you have just raised $5 million in your Series A. And you raised $5 million because you realized, all right, you took a seat back and you're like, okay, I'm going to hit the ceiling of my current retail marketplace in about 2 months. I'm raising the Series A because I want to enter into a whole new marketplace. But a couple months in, you're like, okay, great, I'm going to start this new enterprise product. But then you're realizing, great, oh no, I'm churning through them at a way higher rate than I actually predicted. What am I going to do? And you're trying all of your different tactics to new marketing, trying to isolate the problem, trying to understand the new channels, how you're reaching them. But at the back of your mind, you should still be thinking, wait, I raised $5 million because I'm expecting it to last for the next 5 years. But at the rate that I'm churning through my customers, I'm going to have to raise another round in about 3 years. And that's a much more shorter runway. So something has to change dramatically. But being aware of that and then starting the fundraising process at the right time and also understanding what is causing the problem is really important. The final thing I want to talk about, and this goes to the heart of what JJ is talking about, is the evolution of a company and 3 dimensions of how you think a company should be. One is your company a pure transactional company? So what that means is that I have a product, I sell it to you, bye-bye, I never see you again. I don't care what you do with it, you use it, you don't use it, whatever, your problem. It's a pure transaction. You don't even know the customer's name. Versus a relationship-based one where, all right, you take some time, you try and sell it to them, you get their information, you sell them a couple different campaigns, they develop a relationship. Versus it's the company that you're trying to build an ecosystem-based one where the unit economics of one will feed into the unit economics of another and create a really vibrant marketplace where you can serve multiple types of customers. It's not a matter of right or wrong, it's a matter of choice on the type of company. It could purely be If you are an information-based product where you are selling a book, and all you do is selling a book, that's pure transaction. You just sell it to them, people read it, people don't read it, don't know. And you just list it online. And the reason why I point that out is because when you think about unit economics, sometimes it may not work for one market segment, but it could work for another. Going back to the example of Amazon, their unit economics on their online retail marketplaces, so the basic, whenever you purchase like a shirt or when you purchase shoes or purchase books from Amazon, they're really, really small margins for each of them because Amazon believes in providing the customer experience of low prices. But their other part of their ecosystem, which is Amazon Web Services, is basically what's making them all their money. And that's helping their marketplace, but is overall providing this entire ecosystem of how they're like serving their different customers. So it's different for each company, and the more complex the company, the more your unit economics feeds into each other, and the more important it is to actually understand which ones can you actually segment out and which ones you can get more granular with. So with that, I want to actually have a quick discussion about Box, which is the article that's in front of you right now. And not necessarily in the sense that I'm going to quiz you on Box and their business and what the decisions they have made, but I believe that the article actually encompasses a lot of like the different points that we've talked about, that they've hit their ceiling of their marketplace and they decided to pivot, or they're thinking about runway in different ways. I would like you guys to just take a second, read the article, and just share with me, share with everyone actually, what is your aha? What is something that you read in the article that really stood out from you from the entire 90 minutes that we had spent together that you just would like to share? Whether it's something super simple or whether something that you had never known before, something related to unit economics that relates to one of the concepts that I've just talked about. Anybody have anything to share?
Sometimes it's a good idea to spend a lot of money to acquire a group of customers.
Yeah.
In Boss case is a free user.
Yeah.
That eventually they hope they will turn to the enterprise customer.
Yes. Yep. Excellent. It's true. That's understanding. That goes back to what I talked about right in the beginning. What is the type of customer that you acquire?
But this is very difficult to work in Asia because the money they're losing is.
Anyone else? Yeah.
For me, I have a lot of these storage boxes thrown at me, and I just get in free, but I don't really use it because it doesn't enhance any value.
Right.
In the end, I actually paid for structured enterprise boxes that can add value to me, where I can see that it actually helps my business. So if you are just throwing free for the sake of acquiring customer, I think it's defeatist. There's no value unless you can, convert it at least to some useful customer, paying customer.
Right. And that goes back to the cost to acquire a customer has to be less than the lifetime value of the customer, which goes back to what value are you providing to your customer and how are you retaining them in that bucket, right? How are you making them stay? Anyone? Any insights? Anything? Oh, great. In that corner.
Okay, hi. In my opinion, I think my point of view more on product side, because before this I'm using Dropbox, and then now I migrate into Google Drive.
Okay.
The reason why is because Google Drive, the function is much more dynamic. So which means that you can view video and then you can do all the PDF and everything, Office-based software in the Google Drive, and the upload speed is very good.
Right.
So more on benchmarking point of view.
So you're just talking about it from the perspective of churn.
Yeah, churn.
So why did someone leave? He left because there's better integration with Google Drive and all the other services that you have. So if I was Box and I was running that company, I would want to measure how many people are leaving because of what reasons. If they're leaving because of Google Drive, why? And how can we actually compete against that? Do we care that some of our users are leaving because of Google Drive, right? Yes.
I think what I took away from this article is that I'm not very, I don't know much about the tech scene actually, but I was very surprised to see that people are willing to invest so much money into a loss-making company, and why would they do that? And it seems that it's not really making profit very much as well to counter that. So why would investors do that? I'm just curious. Yeah.
That is the golden question. It's basically they believe there is longer term value for the company that in the future. That sometimes when you think about value is not immediately apparent in the first month of operations. Value can come 5 years down the line. And so that's what they're betting on as opposed to value creation right now. Yeah, but that's a good question.
Yeah, it's a very good question. So I'll just share some insights.
Yeah.
I've seen some businesses that they will never be profitable because of the cost of acquisition the consumers compared to the lifetime value. So what happens is that people are willing to invest in that because they create an ecosystem that brings a greater lifetime value for the customer that come into this rather than just standalone like services, but they actually create more value when they actually shop in other stuff or the services in the ecosystem. So that's the reasons why some people are actually interested to invest, even though it's not profitable in the standalone.
It's true. Yeah, that could be a reason. Absolutely. Yeah.
Do you think this story is similar to Uber story? That Uber is operating as a loss as well. That the taxi, you hire a Uber car, right? It's much more cheaper now than you hire a taxi. I think it's similar.
I think I'm not sure. I don't want to put sort of assumptions on Uber's like economics and the way that they're running their business, but it depends. Like they have very different strategies on how they create value out of their single unit, which is the single taxis and cars. It could be different countries are priced differently, and different cities they give different prices. They have surge pricing as well during peak hours, which could make up for things. It's hard. I don't know enough about Uber's economics to actually comment on how similar it is to Box. Yeah.
Yeah, I think the questions you mentioned is about customers living. But in Box case and this free storage, it's not about customers living. It's about, if you go down the metric, it's about big customers. Because it's just do that with nothing, right? And also what you call the active customers. So I think you need to segregate what is big customers and active customers.
That's true. That's amazing. That's perfect customer segmentation and really great insight. Anyone else? Yeah.
Well, I think what is really missing over here is about the Box, about the key metrics of its valuations. Because just like Facebook, that you're also making a lot of losses, you know, at the first few years of operations. But what Facebook claimed that they have a key metrics that they have millions of users, and I think that's where it makes the valuations of the company to be more than what they are losing. But in these articles, I didn't see there's any key metrics about the users, and of course other things as well.
Right. Yeah, I don't think the focus of the articles was the number of users, but more so, I think the bigger insight is how they have a marketplace and have a single product offering, and then realize that they are tapping out on the growth of that market, and then started offering other services on top of that is the sort of the key thing, besides all of the other sort of calculations in between for that. But that's a good point, that one of the things about valuations is how many users do you have, is one of the metrics. Yep. Any other questions? Yep, in the corner. Can you yell?
Not a question.
Oh, okay. Okay, statement. Excellent.
Because I was reading the part whereby they say they calculate the free users.
Yes.
They calculate the free users as a marketing cost, and that kind of converts, but they are also hoping that whatever converts are the big enterprise customers. So I think another way to see it, since free users is a marketing cost, if you have another marketing strategy that gives you basically a lower marketing cost, they can actually employ it instead of still sticking to the free account strategy. It could be maybe instead of offering free account, I can be advertising my paid services, that could be one, or maybe I could limit my free account to 3 months trial. Then after that, if you're still using it,
well, you have to pay for it, or something to that effect. I mean, just something I was.
Okay, great. Yeah. Yeah, they have an interesting way of treating free customers as their marketing cost, and that could be a way that you think about your economics as well. Maybe that's not even part of your graph at all. Like, again, it goes back to the very first question that I posed to you guys. What is your unit? Maybe a final question or statement? Anyone? No one. Oh, great.
I just want to comment on the Uber thing just now. I think that Uber's model and Box model is very different in the sense that Uber actually aims for monopoly, whereas Box in this space is so crowded, it's actually very hard for them to be the only player in the field. So like Facebook, like YouTube, because they are the only big player in I mean, it's not the only big player, but they more or less monopolize the market. They can put ads and people will still stick around because there's just nowhere else to go to. And right now, Uber, with all the billion of cash, they are trying to really gain the market share massively, quickly. And then once they kill off all the players, then they might actually, in fact, I think it's happening in US in the sense that they gain so much market shares, they actually start lowering their price and and subsequently also lower the driver's fees. So yeah, so then they can make a profit with a much lower fees than a taxi in a sense.
Yep, that's true. Some unit economics work only with scale, and I think to a certain extent, I think that's Uber's strategy. Great. Well, thank you guys. Seems like you guys really absorbed like the piece, which is amazing. Great. I thought it was a little technical, but I'm like, okay, great. Let's just throw it to you guys and see whether it sticks. All right. Well, the final thing that I actually really want to leave you guys with, and this actually brings me to the end of my talk. We've talked about the spectrum, product to services. We talked about SaaS being smack right in the middle. We talked about SaaS as a leaky bucket and sort of the 4 things to keep in mind: type, amount, time, type, amount, and rate as the 4 things to chart and always like keep asking yourself. And the differences between sort of what is the unit economics of a product and the input and output of that versus a services company when your unit is an individual. So that's kind of like what we've talked about so far. And the final thing is, one of my favorite quotes actually is by Einstein, and just keeping in mind that sometimes not everything can be counted, and not everything that counts. So this is just more so for you guys to remember. Don't overcount things, because I know that I told you guys to count everything, but sometimes some things don't need to be counted. So keep this quote in mind when you're sort of building your own customer tree. And that's it. Thank you so much. Tweet to me. Happy to answer any of your questions. And thank you so much for being such an amazing audience. Hopefully you learned something about unit economics. Thank you.